folks, welcome to this video on finding bond interest expense over the term of a bond. So we've talked in a previous video about how we calculate bond discount and even bond premium, although to this point we've focused mostly on the discount bonds. And we also talked about the concept of interest expense when we say that once the bond is issued, we have to book interest expense for all subsequent periods that the bond is outstanding. Why? Because whenever a company issues debt, that means they have to book a cost of borrowing money, and that is basically interest expense. Sometimes companies want to know when they issue the bond, how much interest expense would they book over the entire term of the bond. So we can use an example that we're familiar with, our billboard example again, just to show you how we would find the interest expense over an entire bond term. So let's go back and look at our example here. So we have on August the 1st, 2017, Billboard issued $520,000 of 10% 7-year bonds. Don't forget, issuing means that they are selling, right? $520,000 is the face value of the bonds. The bond coupon rate is 10%. The bonds are going to be outstanding or they mature in 7 years. And again, we have interest paid semi-annually, which means that our N, or number of interest payments, is going to be 14. Notice here that we have a coupon rate of 10% and a yield of 12%. So that means that the bond is going to trade at a discount. Why? Because the coupon rate is less than the market or yield. So now, last time we worked on calculating the issue price of a bond. We referred to them sometimes as cash proceeds or the present value of the bond at the date they were issued. In order to get this number, what do? Well, make sure that because your bond is paying interest semi-annually, that you set your P/Y in your calculator as 2. Your calculator is set for P/Y, whatever you set it to automatically set your C/Y to that as well. But many of you will sometimes change your C/Y for other courses you take here at the college, so make sure your P/Y and your C/Y are the same for this problem. And again, it has to be 2 because P/Y stands for the number of payments per year, and that's 2. So now, to find the present value or the cash proceeds, also known as the issue price, we have to use our calculator to make the calculation. So how do we do it? Well, first of all, we want to put in the fact that we, Billboard, are going to be paying back to investors $520,000 in 7 years. So we put $520,000 as our future value. Future value means that's the amount we will be paying them back in 7 years. And because we're paying them back, that means cash is going to flow out of our business to pay back our investors. That's why I put the plus minus sign in there. Plus minus would indicate it's an outflow or a negative. The other thing we have to pay them is we have to pay them a series of interest payments. So we have to calculate our PMT. And our PMT is going to be $520,000 times our coupon times 6/12. Why 6/12? Because the payment is going to be made every 6 months. Don't forget, all your interest rates, unless you're told otherwise, are always going to be annual. So we've got a 10% annual coupon rate, but don't forget, we have to pay interest twice a year, every 6 months of 12. So if the 10% represents a 12-month rate, we only want interest payments for 6 of 12 months. And notice that to find our PMT, we use the coupon rate. We don't use the market rate, we use the coupon rate, all right, to find our PMT. Our N is 14. N is the number of interest payments, and we get that by taking the term of the bond, which is 7 years, times 2 payments per year. And that's going to give us 14. And then we use our market rate or our yield, which is 12. So we put 12I/Y in our calculator. Notice we don't cut this rate in half. The calculator's smart. It knows that it knows your 520,000. It knows your 26,000. So it already knows that you are going to be entering in an annual rate. So don't worry about that. You just leave your rate annual, right? When the calculator looks at the future value, the payments, and the number of payments, it already knows that you're looking semi-annual. So you just leave it annual. Don't ever change it from an annual rate. And if we do a compute PV, you're going to get $471,666. Now, we would have expected to get proceeds less than the face value. Why? Because we said it was a discount bond. And with discount bonds, what do we know? We know that with a discount bond, coupon is less than market rate, and we also know that cash proceeds at the issue date coming to Billboard should be less than the face value. So maybe we should just type that in. We know this is a discount bond because coupon rate is less than the market rate. So cash proceeds coming to Billboard, fix this up, coming to Billboard from investors is less than the face value. Why? Don't forget, because your bond's only paying 10%. The market's paying 12%. These people are not going to give you the full face value of the bond. They're not going to give you the full 520 or even more than that because your bond's not paying as much. So they're going to give you less. So with a discount bond, coupon's less than market, so we should expect cash proceeds to be less than face value. And that's what we've got here when we calculate 471,666. So now at the issue date, which if you go back here is August the 1st, right? We're going to set up the cash that Billboard's getting. So don't forget, we're the accountants for Billboard. We're going to debit it 471,666. And now we're going to debit our discount. Don't forget the discount account we've introduced to you before. It's a contra liability account, so its normal balance is debit. So when we set it up, we debit it. And that discount is the difference between the face value of the bond and the cash proceeds at the issue date. And that's $48,334. And the credit is going to go to bonds payable. Okay, and that's your liability if you're Billboard, and your liability is $520,000. So now, the company would want to know on this bond, don't forget, it's going to be outstanding for 7 years. Over that 7-month period, how much interest expense am I going to have to take into income in total over that 7-year period? Well, there's 2 different ways you can calculate that amount. There's 2 different ways to calculate it. So the first method that you can use to find the interest expense over the term of the bond is by comparing 2 amounts. How much money did the investors give Billboard when Billboard issued the bond? So how much did the investors give them? And compare that to what Billboard has to give them back or pay them back. Let me give you an example. Let's say you come to me for money. Mrs. Tristani, I need to borrow $100. Can you loan me some money? And I say, sure I can. When can you pay me back? And you say, in a week. I say, well, a week, that's fine. But in a week's time, I want more than $100. I want $105 from you. So what does that mean? You're giving me back $5 more than I gave you. Well, that $5 represents what we call interest. So I'm loaning you money. I want to be able to make money back. That's interest revenue to me, but that's interest expense to you because you're borrowing the money from me. So that's just like Billboard. They're borrowing money from their investors too. So in our case, we're going to compare what Billboard got when they issued the bond to investors and how much Billboard has to pay their investors back. So just like that $100 that I loaned you, as opposed to the amount that you're going to have to pay me back, which is $105, right? So that difference is going to be the financing charge, or what we call interest expense. So to calculate the amount of money that Billboard got from its investors, we already know that. That's up here, cash, $471,666. But how much did Billboard pay to its investors over the term of the bond? Well, they paid them back the face value of $520,000. That's why we got the liability set up here. That liability is going to be cleared in 7 years, plus the interest. Don't forget, we paid these guys. Remember the PMT we did up here? We paid these guys $26,000 every 6 months for 7 years. We made 14 payments of $26,000. So we not only gave them the face value back, we gave them interest every 6 months for 7 years. So every 6 months, we gave them $26,000, right? And we did that 14 times. So if we paid $26,000 14 times, that's going to be $364,000. So now, Billboard paid its investors $520,000 at the end of this 7-year period, plus over that 7-year period, they would have paid them interest of $364,000. So now we know that Billboard would have paid back $884,000. Well, wait a minute. The investors only gave you $471.66, and you're paying them back $884,000. Wow, that's a lot of interest, isn't it? How much interest is it exactly? It's the difference. It's the difference between what you had to pay them back, which includes interest, plus how much they gave you, or minus how much they gave you. And that difference is $412,334. In business, we call this the financing charge, or the cost of borrowing the money. So if you had to pay back your investors, if you're a Billboard, $884,000, and they only gave you $471,666, you as Billboard incurred interest expense over the term of the bond of $412,334. Another way you could do this, and again, don't forget, we're only focusing on discount bonds here. The other way you could think of this for a discount bond is just a little formula. Interest expense over the life of the bond is interest paid plus our discount. Don't forget, at the date we set up our bond, we had a discount here of $48,334. So what does that mean? That means that our interest expense is equal to $364,000, which is the interest paid plus the discount at the issue date. That would also be $412,334. So we get the same number here in method 1 as we do in method 2. So what do you know from this? You can tell here that interest expense, just a little learning point here, interest expense is greater than interest paid for a discount bond. We know this to be true, and this should make sense to us. Why? Because the interest expense is based on your market rate of 12%, and the interest paid is based on your coupon rate of 10%. So the issuer, Billboard, is booking more interest expense than they normally would because they couldn't afford to pay the market rate. They decided, for whatever reason, they're not paying the market rate for bonds for this bond that they want to issue. They're not paying the market rate. They're paying the coupon, which is less. So in that sense, the issuer, Billboard, recognizes a little bit more interest expense than they normally would if they are, as in this case, because their bond isn't paying enough. So their bond is only paying 10%, and investors generally want 12%. So in this case, because the bond's not paying as much, we look at the additional interest expense, or the extra interest expense over the interest paid, as a little bit of a penalty to Billboard because they can't pay the market rate. So hopefully this helps you to better understand the whole concept of calculating bond interest expense over the term of a bond for discount bonds. So don't forget, we were only doing this for discount bonds. All right, so we'll do another one a little bit later on premium bonds, but I hope you found the video helpful.